Hello to everyone who's here. So just give us a moment. We'll get started very soon. Okay, I think we can start now. So please, let's all confirm that you can see the screen I'm currently sharing. And just reply in the chat. Okay. Okay, so let's get started. So welcome everyone to our class on technical analysis basics, price charts, tools. So it's a very fundamental class really. So we're talking about technical analysis, price charts, tools that you can use to, really do technical analysis and what technical analysis means, and what it is, what it's not. So get to that in a moment. All right. So okay. First of all, I'd like to thank our sponsor, Binance. So without the Binance's sessions wouldn't be possible. They make it possible. So I'll drop a link in the description. I said sorry, I said link in description. I'll drop a link in the chat. So if you're interested in opening a Binance account, do that. Show them some love for sponsoring us, making all this possible, making all this free. So let me just do that quickly, then we get started. All right, so that's done. So if you need an account, you can get 15% off Binance accounts. Also, there's a $2,000 reward pool for people who sign up with this link. So you need to sign up, trade a few times, and you'll be eligible for that reward, to share in that reward of about $2,000. So I think we can go on from there now that it's done. So, okay, so welcome to Technical Analysis Basics, Price Charts and Tools. So let's look at our contents. We have introduction, we have what is technical analysis, history of technical analysis, the Dow theory, 3 major assumptions of technical analysis, and we'll move to what are price charts, how to read price charts. So we'll also show some live charts to really get you into the basics you need to know. So okay, let's quickly move on from that. So okay, introduction. Let's quickly look at the introduction. So basically, we'll talk about markets and price prediction. So let's get into that. So markets are basically, any location, whether physical or virtual, where people meet to exchange goods and services and money, blah, blah, blah. So basically, in financial markets, we have 2 methods which we use to analyze financial instruments. So if you don't know what financial instruments are basically any asset you can trade, any assets that is tradable. Those are financial instruments. Examples are gold, FX, crypto, what else? Wheat, anything that is tradable. Those are financial instruments. So there are two primary methods in which people, traders or investors, analyze financial instruments and make investment or trading decisions. So we have fundamental analysis and we have a technical analysis. So fundamental analysis, basically, that is, you're trying to find out the intrinsic worth of something. It's like let's say I have my phone here, and you look at this phone and say, what is this phone worth? And you begin to say, oh, the way you determine how it's worth is you look at the specs. You say, oh, okay, my phone has so inches of screen, has so specs of battery, is the latest iPhone model, can do this, can do that, can do that. So basically, that's how fundamental analysis works. So, for example, if it's a stock, you're looking at, what is the company's financial statement? How much revenue have they made? How much profit have they made? If it's a currency, you're looking at things like macroeconomic trends, indices. So let's say we're looking at pound sterling now. You say, oh, how is the pound doing? You'll be looking at what does the economy of the UK look like? What are they, what's their GDP, that's short for gross domestic product? What's other economic indices like their trade balance, what's the level of employment in the country, how much they export versus how much they import. All those are for economists. So basically, people use those things to, try and determine what's the fair value of the stock, what's the fair value of the currency or assets, or even, if I want to buy gold now, why is it worth so? That's fundamental analysis. So technical analysis it simply assumes that the security or financial instrument's price already reflects all publicly available information. So, all this information that goes into fundamental analysis when you're trying to value a stock, value a currency, value an asset. Technical analysis assumes that every single part of it is already reflected in that price. You understand? So if I say today gold is $1,000, if that price of gold contains all the information you need to know about all this other, about the worth of gold, really, you get. So how much, whether people are buying a lot of gold right now, or people are selling a lot of gold, or people are, really value gold at this point in time, or a lot of intrinsic things that you might not necessarily know about, but all that information is already into the price. So what technical analysis does is it now focuses on the statistical analysis of those price movements. That is really what we can use that's what has a prediction power. So technical analysis also, it attempts to understand the market sentiment behind price trends by looking for patterns and trends rather than analyzing an instrument's fundamental, basically what I've said already. So let's move on to the next slide. So, okay. All right. So, okay, what is technical analysis? Technical analysis it's a discipline that where investors and traders, when they're looking for opportunities in the markets, they using all those statistical trends that they've gathered from trading activity, such as price movement. So basically, they'll look at the history of price. let's say I'm trading even something as mundane as pepper. I look at price of pepper, say, oh, okay, in January, pepper was 50 naira. Maybe one can of pepper was 50 naira. And in March, it's now 100 naira. So what can that tell me about the history, of pepper, and how can I predict what the price will be next year, May, or next year, June? So that's technical analysis really, basically. So technical analysis, also referred to as charting, is a type of analysis that aims to predict future market behavior. So I've already talked about that. So it talks about price action and volume of data. So volume data is, in the example I use now of buying a can of pepper, you are looking at how many people were buying that can of pepper. I don't know if you've ever heard of this theory of big crowds or theory of big numbers. So what that theory says is basically when a lot of people do something, that thing is more likely to be true. So in this regard now, what that will mean is if a lot of people buy pepper at 50 naira, let's say 80 people buy pepper at 50 naira, and 20 people buy pepper at 70 naira, it's more likely that the fair price of one can of pepper at this point in time is more likely to be 50 naira than it is 70 naira, as I said. So that volume data is usually very important in technical analysis. So let's move on to the history of technical analysis. So technical analysis, where did it all start from? So it was first of all, technical analysis was first of all introduced by Charles Dow and the Dow theory in the late 1800s. So several noteworthy researchers, traders, like all these white men, contributed to the Charles Dow theory. John McGee is a very important trader, investor. So they contributed to this Dow theory that helped form the basis of technical analysis. So in modern day, technical analysis has evolved to, including a lot of patterns. You begin to see candlestick patterns, normal or single candlestick patterns, maybe other patterns like maybe here, head and shoulders, cup and handle, and all these patterns and signals and the trading signals they give have been developed through many years of research and other people actively trading and investing using all these ideas. So there are a few things that the Dow theory assumes. So we'll go through those assumptions right now. And those assumptions are very critical to understanding why technical analysis works per se. So the Dow theory assumes that markets are efficient and the value representing factors that influence, that markets are efficient, meaning that all the information that you need to know about something, about the worth of something, is already found in the price. It can be found in the price. The second assumption is random market movements appear to move in identifiable patterns. You understand? So, when you see price of let's use gold, for example, it moves up today, comes down tomorrow, that those price movements are not just random. And if you look at the history of gold, maybe over 5 years, over 1 year, or over 10 years, you can see there's actually an identifiable pattern. And you begin to study, you begin to see trends that tend to repeat themselves over time. I know this whole idea brought about these two assumptions, especially number two, brought about the idea of what they call market cycles. So basically, we have what they call market cycles. Market cycles are periods of time in which an asset behaves in like a particular way, you know. So we have, for example, what we call the bullish market, which is an uptrending market here. So in a bullish market, prices tend to go up, you know. So you see prices going up, that's the direction mostly. Then we have what we call a bearish market where prices just tend to move down. You know, by the time you really zoom out and look, oh, over a period of this 1 year, let's say Bitcoin, for example, Bitcoin went down from 10,000 to 4,000, $10,000 to $4,000. So that is, you know, those are the trends. You begin to see those trends and repeat over time. So you see there will be a trend period of an uptrend, right? You know, an uptrend will look something like this. Let me see. Okay, let me see if I can draw. Right. Okay, so an uptrend will look something like this. You understand? So this is an uptrend, and a downtrend will look something like this. You understand? So you can see that, oh, over time, prices, you know, let's say this was January, and this was December. This is January, this is December. Over this period of time, you can see that, oh, this thing has moved from, let's say, $100, and it's now $30. Forgive my handwriting. So, you know, you can see clearly that, oh, this thing is trending downwards. Here you can see that this thing is clearly moving upwards. So that's that. So based on this, you know, this was in far back in the 1800s where you know the earliest financial markets were really getting sophisticated and all. So based on this thing now, traders now, based on his theories, you know, a lot of knowledge that we have now is built up on what was learned in the past. So you see that the market discounts everything. So these are the things that traders now base modern day technical analysis on. The market discounts everything. Price moves in trends. So this is still back to the theory that, oh, everything you want to know can be found in the price because the market is efficient. And you know, when they say the market is efficient, it basically means that because of the way information spreads, you know, people that are, for example, those really smart investors and traders that work for the big banks like, you know, JP Morgan and Citibank and all IG and all those very big banks, they, you know, they're able to get information that allows them to properly value, you know, stocks, currencies, assets, whatever. So and they quickly adjust their position or their portfolio based on all those information. So everybody will eventually get to know that, oh, something happened. Let's say we're talking about British pounds, which is pound sterling, and the economic report comes out and, oh, the pound just falls. The information is available to everybody, or it will become available to everybody after some time. So that price would reflect all the information that everybody knows already about that asset. Sorry. And that's what makes this assumption, you know, very, very useful. So the second one is price moves in trends. So as I said earlier, price tends to move in trends. You know, you basically have three modes that a market can be in. One is an uptrend, which, as I said, an uptrend, which, as I said, would look something like this, which I said an uptrend would look something like this, where you see prices rising, look something like this, you know, and a downtrend, which will look something like this, Yeah. So there's a third one, which would be a range, really, which would, just look something like this. Price is just moving anyhow. Price is confused. You understand? Where you just see it just seems to just be between a kind of range, you know. So that's that. But most of the time, it tends to move in trends. Then another thing is history tends to repeat itself. So, if you go to any asset that has traded for years and years, you see that there has been a period of an uptrend where, so if you look at the price chart, it will always look something like this, you know. There have been a big period of an uptrend. There have been some period, maybe it started ranging, maybe it started going on an uptrend again. Forgive my drawing. So, after some time, it decided that, oh, I'm not going up anymore, and begins to go down. Maybe might not get to a range for a while, go up, and start coming down again, This is basically what market data looks like. If you see price charts, this is what they look like. So what will happen is this continues to repeat itself over weeks, over days, over weeks, over months, over years. Goes up after a period of time, starts to range. After a period of time, goes up again. After that, comes down, range, go down again, and the cycle starts all over again. So that's what they refer to as market cycles. So basically, okay, let's move on. I think that should be clear. So now let's really look at what technical analysis is not. So technical analysis, basically as used by investors and traders, is you're looking at the history of price to try and predict the future. But this is like a disclaimer. It is not, technical analysis is not a way to know the future prices of an asset or financial instrument. That's why it's one thing that used to happen in my community is, well, people will ask me, oh, what is like, well, be asking for like signals basically, and say, oh, when do I sell Bitcoin? When should I buy? Should I buy? Should I sell? I'm not an oracle. I'm not a DBA or whatever. So if I use technical analysis, but I cannot know the future price of an asset. Technical analysis cannot tell you the future price of an asset, so that you know for certain. So what you can only have is a kind of prediction based on the price history. You understand? So, and that leads me to the second point here, which says predictions based on technical analysis are probabilistic in nature. So now let me explain what that means. That means based on the history of price, which is what technical analysis is, you're analyzing the history of price. You can now, if you're, when you really get the tools to really analyze properly, as you learn more, you can assign what we call probabilities, probabilities to your analysis. And I will still explain more by the time we get more into more. We will look at live price charts and get more into the theory of everything. So those predictions, you assign them probability. Oh, okay, on a scale of 1 to 10, I give this a 5, 50, that's 50-50, 50% of this trade or this asset going up or coming down. So, you assign a kind of probability to it. So predictions based on technical analysis are probabilistic in nature. That's one. Then 2 is they're usually combined with proper risk management before they can be acted upon. So, any prediction you make with technical analysis has to be assigned a kind of probability that, oh, this thing, 20% likelihood of happening. Then what a smart investor or trader would now do is you manage your risk accordingly. And that is, you use proper risk management. So if you say something is likely, 20% likely to happen, you have to adjust. So you don't go and pour all your money in it. You have to adjust your risk. so that it doesn't affect your whole capital. You understand? But if you say something it's 90% or 80% likely to happen, I think 90% is a little bit too high. You also adjust your risk, and so you can take better chance on that opportunity, because you say you feel it's 80% correct, or sorry, 80%, no, sorry, not correct, 80% likely to happen. So that's the probability of the whole thing. And that's how, as a trader, one thing you have to learn over the long run is how to think in probabilities that, oh, okay, this is the probability of this happening, and how can I adjust to take advantage of this opportunity? So that is it basically. So you cannot know tomorrow. I trade Bitcoin almost every day, and I cannot tell you if Bitcoin would not go to $0 tomorrow. You get. Now, as we said about probability, the likelihood of that happening is actually very low, but it is there. So that's what that's what you call probability. So I can also tell you that Bitcoin is going to go to $100,000 tomorrow, because probability of that happening too is actually very low for now, based on what we can see on the charts. So I digress. So now, what are price charts? Price charts are simply a graphical representation of a financial instrument. And I think I've said a financial instrument is anything that is tradable, usually tradable on an exchange. So a graphical representation of a financial instrument's price movements over time in any given market. So if I look at, let's say Bitcoin, well, we're going in a crypto market. So if price charts can give me, a graphical representation that would look like, which I would have already drawn before, which I would have drawn and say, it looks something like this. Say, price chart probably look like this, something like this, and it's like this, like this, like this, like this. So this is a graphical representation. You have on this axis, you have price. I'm on my handwriting. And we have time. Understand? So it's just a graphical representation of the financial instruments price movement over time in any given market. So, I can see that, maybe on a market, you say maybe this is 10, 20, something like that. So that's what it looks like, over time. And I say, this is August, and I can say, this thing was $20 in August. In May, it was maybe, it went lower, that kind of thing. So those are what price charts are. Just, you are able to see, instead of, if I wrote all these prices now, it would be harder for you to really read what prices have been doing over time. So that's what basically price charts are. So what do they do? What functions do they serve? They tell us the history of the financial instruments and how it has moved over time and responded to reaching key price levels. So now there are many types of price charts. The most popular ones are, they have line charts. What I just drew now was a line chart. So we have the Japanese candlestick charts. That's another type of chart. Then we have the bar charts, or OHLC charts. I'll still tell you what this means. Then we have Kagi charts. There are a lot of charts that traders and investors use, but the most common are the Japanese candlestick charts. So we'll move on to how you can easily read those charts. So how to read candlestick charts is actually not so complicated once you get the hang of it. So this is what it looks like. So these are Japanese candlestick charts. They were named after, they look like candles, basically. If you have a candle, just think of, this is the body of the candle, and this is where you used to light your fire. Remember when we used to use candle? I don't think anybody uses candles anymore. So basically, we have two major types of candlesticks, and We have one, which is the increasing or the bullish candlestick, and we have the bearish, decreasing or bearish candlestick. So this is the way it works. On the price charts, this just represents the, how price has moved over a certain time period. So what happens is this candlestick that you see here is usually over a certain period, let's say 1 hour. So it now has some markers that allow just at a glance, let you know, oh, this is what has happened over time. So in this bullish candlestick, we have what we call the high, which means the highest price that was traded in that market, over that period. Let's just say this candlestick is 1 hour. This is a 1 hour candlestick, let's just assume. So that means in a period of 1 hour, this high was the highest price traded. The high tells you the highest price traded. The close, what the close tells you is the final price at the end of that 1 hour session. Where did the price end up staying? Do you understand? So let's say, okay, let me go ahead. Then we have the open. This is at the beginning of that 1 hour session, which is this candle. Where did it start from? Where did it open? Where did it start from? So basically, the low, I'm sure you can guess. What was the lowest price in this 1 hour session? Sorry. What was the lowest price in this 1 hour session that traded, And the beauty of this, of candlestick charts and even all other charts candlestick charts in particular are, all this, the whole candle itself, it only represents what was actually traded. Like if price did not trade, let's say this high now was $100, and above this high we have 101. If price did not trade up to 101, the high here you're going to see is $100. So that is only where price traded in this 1 hour. And that when you're looking at price history, it begins to give us that kind of picture. We know, okay, this was the limit. When you look at the high of the candle, see that means, oh, this was the limit. This is where it got to and it stopped. Right? And you look at the close. For example, if you look at the close, look at the high. Say, oh, that means at this it got to this $100 and it stopped moving, and it now came back down, and this is where it ended up after the 1 hour. So when you begin to look at it, it begins to tell you a lot of things, which you can now you can analyze and base your future prediction on. So that's it for the bullish candle. So basically, as I said, it's always in a time frame. It could be 1 minute, it could even be 1 second. 1 second, 1 minute, 5 minutes, but there's always a time frame attached. There's an open, there's a low, there's a high, and there's a close. You understand? So sometimes the close can be the same thing as the high. What will happen is, instead of seeing this, this is what we call the wick. This is what we call the wick of the candle, and this is what we call this is also the wick. These are bull wicks, and this is what we call the body. So instead of, let's say in a 1 hour trading session, the session ended up on the high. So what will happen is there will be no wick on top. So you just assume that this is not here. Sorry, this is not here. So, the close will be the same as the high. So it just, they just shows you points, same as if it opens on the low of the session. So that's what it is. So for the bearish candle, is flipped, The open is usually, that means a bearish candle, that means the price actually decreased. So you see that the open is on top and the close is below. In a bullish candle, we have, which are usually green, the default color on most charting platforms are actually green. You have the open here and the close here. You understand? The close is higher than the open because obviously the price went up. Here, the price came down. So the open is lower. The open is higher than the close. So that means, so let's say you opened at $80, went up to $100 here, came down to $20, and maybe eventually closed at $30 here. You understand? So I don't know, have I been clear so far? Am I losing anybody? But I think this is not so complicated like that, Sha. But any questions, anything? So I just saw in the chat that someone can hear the audio. Can everyone else hear the audio? Is there any problem with the audio? Hope I've not been talking to myself all this time. The audio is fine? All right. So, okay. Okay. So let me continue. But please, if there's any problem, you can't see my screen or anything, please don't hesitate. Don't hesitate to, mention me in the chat. So that's that. So that's basically it with candlestick charts. Is it not clear? Does anybody have any issue? Is it not clear? So we know what's up. Okay. So once we're done with this session, we'll move on to other things, right? So move on to questions and all. So okay, let's move on. So now there are some tools we use in technical analysis to, like what we call annotate charts, just basically draw on your charts, and what they do is they assist you in understanding how the price of an asset has been behaving, over time. So, and what does that do for you? It helps you to be able to predict the price behavior. So there are three major technical analysis tools that everybody uses really, so we have horizontal lines, trend lines, and indicators, basically. So we'll go now to live charts and see how all this are going to work. So I'll hand over to Amara, my partner Amara, and he would take us through some live charts and how we can really use all those tools. So Amara, hope you're still with us.
Yeah, yes, I am.
Okay, so I think let me stop sharing my screen here. Okay. So.
Okay, let me quickly put up my screen. Yes, I hope you can see my screen.
Yeah, you can see it.
That's great. So, actually, Similar just dropped a bomb on me. Well, so let's just jump right into it. Let me not delay you guys with any unnecessary talk. So right now we want to talk about horizontal lines, we want to talk about trend lines, and we want to talk about indicators. Now, if you're seeing my screen, you would notice that what is currently on my screen right now is a bit difficult to see. Just looks like dots and like a line that is trending upwards. Now, by trending, what I mean is simple. Okay. So to help you see clearly, I will just quickly draw a trend line to help you make sense of it. Now, a trend line is usually connected in an uptrend. Okay, let me take this slowly. There's two different kinds of trends. Let me mention this a little bit. There's two different kinds of trends. There is an uptrend and there is a downtrend. Now, an uptrend is defined as the movement of price as it formed higher highs and higher lows. So as price is going upwards, if you see where my arrow is at the moment, and it keeps this is price. This is we're looking at the share price of Apple, Apple the company, and we're looking at the share price and what Apple the share price has done from July 2018 to its present value today, August 28th. So now, if you look at this price chart, you can generally see, well, just with your eye, that price has gone up, come down, gone up again, come down, gone up again, come down, gone up again, and come down. And right now, it's just going up with those signs of slowing down. And this is what we generally define as an uptrend. Why? Let me quickly point these out. I'm just going to drop arrows so that you see the points I'm looking at while you're looking at them. Right now, price got to this level, somewhere here, and started heading down. Now, this is the high. The idea behind a high is that it is a point where price hasn't gotten to in the past. So if anything breaks higher than this current horizontal level, which is on the right side of my chart, you will see that that horizontal level is marked as 231 or thereabout, 234-ish. And you will see that, like Similar rightfully said, the chart is denoted by price and time. This is price on the right side here. Don't mind preference. So platforms for the charting the price on the left and put on the right. Whatever it is, it's still the same thing. The horizontal is time and the vertical is price. So like I said, price got to 233 and now started heading down. Went all the way down. I'm looking at my price on the right now, 241, and they started going back up again. Now, this is the high here, and this right here, let me turn this over. Give me a second there. Can you not make it difficult for me? Sorry, I don't work with trading view a lot, so excuse my immune struggle or incompetence, whatever you call it. So yes, so now we can see that price came all the way up here, then went down. And now, next time we did something similar that passed this level was when it got somewhere here, and then it just went all the way and stopped here, which is a new high. Now this is an uptrend. Yeah. And then after that, it started coming down and ended somewhere here. I'm not going to bother about rotating it, but you guys get the point. So now after that, next time price broke this high was this. So like I said, an uptrend is defined by when this high is higher than this previous high. This was the first high, then a low, then the high broke this high, and a low broke the low of this low, showing that these two right here are higher than these two right here. Low higher than low and high higher than high. And we officially have an uptrend. I hope I'm making sense, right? So, but now we've done this with just the use of our eyes. Where do trend lines come in? Now, if someone was to try to look at this chart and maybe wasn't seeing it very well because his eyes aren't experienced, one way he can easily look at this and make sense of it is by using a trend line. I just clicked on this trend line right now, this icon here at the top left of my screen. And I'm going to tap on this low here. It is drawn, a trend line in uptrend is drawn from one low to the next low, and just like that. I hope I'm making sense, guys. Now with this, we can see that price comes here and comes there, and then if we have to make some sort of prediction, we would expect that, oh, okay, at some point in the future, you don't know how far into the future, but at some point in the future, price is probably going to want to come back and test this level right here, this trend line, somewhere along this trend line, because again, this is how we know that price is moving in an uptrend. Now, the reverse is the case for downtrend. Is what stuff can I use for downtrends right now? I can't think of any at the moment. But the reverse is the case for downtrends in the, okay, let me try. Let me try Bitcoin.
Gold.
Let's try gold.
Or S&P. Okay, no, S&P, they go up. I want to know they come down.
We'll do.
Zoom in on a smaller time frame.
This is good. This is gold right here. I need gold would have come down at some point around 2008, after 2008. So yes. Now, as we can see, guys, this is a very fantastic example. You can now let me make something clear that just in addition to what Timilan said, you know how Timmy talks about candlesticks. Okay, let me zoom in so you guys know what we're looking at. These are actually candlesticks, so you don't like not know. These are candlesticks. It's just that I zoomed out a lot. Now, to help you properly understand what Timilan said, this candlestick you're seeing right here, this one that has my arrow, is the entire price action within 1 day. How do we know it's within 1 day? Because, well, it says it right here at the top left corner of my screen. Gold, 1D, currency com. Now, this tells us that the interval for each of these candlesticks is 1 day. So with this in mind, we know that, oh, okay, this was like in Timmy's example, a bullish candlestick. What happened here? Price started open here at the bottom. Let me zoom in more so you can see it properly. Yes, this is fantastic. So price started at this bottom, at this low, this open here, where my arrow currently is, and then maybe eventually drop down. Let's say it dropped down at some point during the day, just 1 day. Everything is happening within 1 day. And then let's say eventually went up all the way up here and formed this high. Remember, I already dropped down and formed a low. Now we now close here, which is why it is green, indicating that, oh, it closed higher than it opened. I hope I'm making sense like that. As you continue to study your charts more, you would naturally be able to understand how to use these charts, these price actions in your trading, everyday day-to-day trading. Now I'm zooming out again to help us see properly what we are talking about. Now, with our eyes, we can see that price started somewhere around here at this top on the 12th of October. I mean, on 10th of October 2012, and just kept falling. This is the price of gold. If you can see it at the top right corner, it was 1,794, and then just kept falling. It formed a significant low here, and then formed a lower high. Remember, guys, for uptrends, we have a high with my arrow, a higher high, then a lower high, sorry, I mixed that up, a higher low, and then a higher high. So for downtrends, the reverse is the case. We have this first up here. I'm not trying to be perfect or anything, but just going to use arrows to spot them for you. And then we have this right here too. And then the next time price formed something significant after doing this down here was up here. Now this is a high, this is a low. Then this is a high that is lower than this previous high, which is why this high right here would now be called a lower high. Now a downtrend is when a lower high and a lower low have been formed in the movement of price. So we have this high and we have this low. Now we have the lower high. So we are beginning to think, assuming everything on the chart now didn't exist. Let me see if I can paint everything out. So it will look like something we're dealing with in real time. Okay, no, this is not helpful. Okay, this should be helpful. Yeah, trading is not exactly my best friend. I don't trade TradingView, but Similar does, and it's actually quite easy to use to teach, which is not here. But just assume everything towards the right now doesn't exist. and we are currently here, we know that, oh wow, okay, price has just formed this high. We are beginning to think, is it possible that we might be entering a downtrend? We don't have a downtrend yet until there is a low that is lower than this. So where do we see that happen? Right here. And at this particular moment in time, we have officially entered. You would hear in the news or wherever you study for your analysis that gold has officially entered a bear market or a downtrend. The meaning is simply that this high and this low are lower than this one and this one. I hope I'm making sense, guys. Now, with that, like I said, you can do this with your eyes, like I've just done. But for some people, it's more convenient to just do it with a trend line. It helps you see things more easily. So again, you connect the dots from the high. Now, it's not exactly perfect. In theory, it's perfect, but in practice, it's usually not. So it's something you have to learn to deal with. Now, let's look at this, for example. You see that price got up to this high, and then it didn't. If I continue to extend this trend line downwards, you see that it wasn't respected. It just did this and then started, like, kept going down. So trend lines aren't perfect in themselves. This is a perfect example to show you that trend lines aren't perfect. If you are trying to make sense of the downtrend, it will be best to do it with a trend line or your eyes, depending on what works better for you. But you have seen for yourself the pros and cons of trend lines. Trend lines help you see the trend. Oh, okay, this is clearly going down. But now it is not something that you were able to put on all the highs. You know, in the previous example, we put them on the lows for the uptrend. Now we're supposed to put them on the highs for the downtrend. It's not perfect, but it still gets the job done. Nothing in trading is perfect, guys. All we just need is something that gives us a higher probability to make money. Now, to stick on horizontal lines, let me make this snappy. In these horizontal lines, now I use arrows to mark this point. I can simply use horizontal lines to do that. If we start from up here, you see what I've just done. I've used this green horizontal line. Let me make it bolder so you can see it very easily. Yes. So now you're seeing right there. Now, this is something, in terms of looking at the price in general, this is something we would refer to as a resistance, in the sense that price got up to that point and couldn't get past that point. A resistance is kind of like a roof. Think about yourself inside your building and you trying to break your head past your roof. It's something you can't do. And that is what you refer to as a resistance in trading. Now, when price successfully breaks that resistance and comes back down and isn't able to break it below, that resistance is now support. So I'll show you an example. So now we've drawn this here for this horizontal line. We're using this to mark our technical analysis to make sense of what's going on. We've drawn another significant high here. We've drawn another one at this low. And let's draw another one at this low. Everything is clear to you. Now let me color the lows as red and let me color the highs with green so that you can see the lows clearly and the highs. Let me delete this trend line because we don't need it anymore. Now, if we're looking at this, can you see how price just kept, where my arrow is right now? We're talking about support and resistance. Now, support is kind of like a floor. Think about support in terms of floors. Now, see how price got to this low. Now, formed a new high, came back and tagged that low. In tagging this low, let's not, okay, I don't want to talk about too much I can talk about, but let's not go into that. This is for other classes in future. But it came back to this low, respected this level, not being able to break it, and then went back up again, like he was trying to get to that high. Yeah. Assuming price now broke, let's assume again that nothing on the right side of your chart exists. Ah, fantastic. Thank you. So let's assume not everything here, colored here, doesn't exist. That the only thing we have is everything here. Now, assuming price kept going, let me move a little bit. Trading view the nice one. Yes, thank you. Yes. So assuming price kept going, And as we got to this point, and we're like, oh, this thing looks like it wants to break this high. We begin to start thinking, oh, okay, we have this higher high here. Yeah. Yeah. Assuming it forms a lower low after a lower high, sorry. And then assuming it forms a lower low after this, we know we'll be in a downtrend, especially. But it hasn't formed yet. So because of this shaded part, we don't know everything here exists. So we're like, okay, we're beginning to shift our sentiment and analysis into expecting a downtrend, but it's too early to say. But how can we know when we are what to expect as we progress? Now, price now comes all the way up here. We're beginning to think, okay, if price breaks above this, that means it looks like this high has been broken. Remember, condition for uptrend is low, high, then higher high. So that means as the price now broke this and came all the way up here, now came back again and now formed something here. You see how we would now be in something that looks like this. Let me trend line to help you see. Let's say price is something like this, and then came back down, and then did something like this. Give me a second, guys. Do you see how if this was the situation that played out rather than this current actual situation that happened behind this shaded part, we would now have been in an uptrend. This is how you understand how to make use of uptrends and downtrends and the rest of them. Now, I hope I have made sense of trend lines. I hope I've also made sense of horizontal lines. You see how we use horizontal lines to mark important points for us. Now, we've marked this point as, okay, what we think was the most relevant high in recent times. Yeah, and so in future we'll be expecting that if price gets there, we want to see whether price will not be able to break it. And if let's say price gets and they're not able to break it, start coming down, we know that okay, maybe it's coming significantly lower. Okay. So it's things like that. We use these things to delineate important points for ourselves, horizontal lines and the rest of them. Now let me clear everything on the screen. Okay. Let's remove all drawings. Yes. Now, if you look at the last important thing that I was going to talk about is indicators. Now, indicators are okay. I like this. Indicators are mathematical, graphical representation actually of mathematical calculations of price. Let me help you make sense of that. That is a very popular indicator called the relative strength index, or short form for RSI. Now, the RSI, I've added it onto my chart. You see it down here. Let me zoom in so you see it properly. Now, if you look at this RSI, it looks like it resembles what price is doing. You get, and then it comes down, and then it goes back up again, and then that's what price sort of looks like. It's not perfect, but like again, I said, it's a graphical representation of a mathematical calculation. This RSI is actually a mathematical calculation. Now, the RSI is, like I said, a calculation. What does this RSI calculate? It calculates, let me open it for you so that you see. It calculates the, trading view doesn't make it simple for us, but it basically calculates the, sort of like the, okay, I think I used the wrong, a difficult example. Let me use something easy. Sorry about that, guys. Let me use something easy. Let's just look at the moving average because it's easy to explain. Now, fantastic. If you're saying, let me make this a little bit quick so you see it well. Okay. I'm struggling with increasing thickness, but I hope you can see it, guys. Let me check the chart section. I hope we can.
Yeah, we can see it. It's clear.
All right, great. Now, for moving averages, a moving average is just basically This one now, this particular one here, if you look at the top left corner of my screen, you see it says MA9 close 0. Now MA9 here, the 9 here is called the period. And this moving average, you see it in input here, length 9, stop, close. Let me explain what these mean. Now, the moving average is simply the average of the close. Now, the source is what? The close. So it's the average of the close of, let me show you. Let's go back to the most recent. Let's go to the most recent time in price. Time. I want to go through so I can explain properly. So this is where we are. This is where gold is at the moment. And this moving average right now, the most recent one, this dot you see here, this one, where it is at this particular moment in time, is the average of this candle 1, 2, 3, 4, 5, 6, 7, 8, 9. It is the average of these 9 candles. But what as you know, these candles have different parameters. They all have highs, lows, closes, and opens. So, like I said, in this, by pointing this out to you, it is the average of the past 9 candles, but the close of the past 9 candles. I hope I'm making sense, guys. This is what indicators are. They are mathematical calculations that help you to make sense of what price is doing. The idea of this thing is that they simplify, so to say, or help you draw reasonable conclusions in your analysis of where you think price is going to go. Again, your analysis is using the present and the past to try and understand and make a proper prediction of what the future is going to look like. So with this, we can say, oh, okay, this is just this off the top of my head. Please don't take this as trading strategy or information or anything. You can say, for example, that, oh, okay, when price is above the moving average. Now, how price is above the moving average? It means that there's a series of closes that are now above the most recent moving average value. So once that continues happening, you can say, oh, okay, it looks like we are trending upwards, even without using higher highs and lower highs and all that. You just simply know, okay, that is like reasonable inference. You guys hear what I'm trying to say. So there's a ton of indicators. There's RSI. This measures strength of price. All the indicators are basically used on price. Now, while some calculate, like you see here, RSI for close, calculates for the close. You could choose, maybe, okay, you don't want a moving average to calculate for the close. You want it to calculate for the open or for the highs or for whatever is convenient for you based on what they're looking for. And it just adjusts as you see. It suddenly went up towards somewhere down. In case you guys didn't see that, let me point out again to you. Watch the moving average guys. Do you see how it changed? Yeah. So with that in mind, there's a ton of indicators, like I said. All these traders across the world and investors alike look for different things in indicators. So let's say someone like, let's just give an example that is just accurate. Let's say someone like Warren Buffett says, oh, okay, I want to see the 200-day moving average. Remember, this one is just MA9. This is 9 days. We're looking at the daily chart, remember. But let's say Buffett he says that he looks at the 200-day moving average. And that when price is above the 200-day moving average, we are in an uptrend. And you're like, oh, okay. And so people use this in different ways. Then there's also a group of people that don't believe in using indicators and just try to focus solely on price action and putting everything out there so that you guys don't take indicators as the holy grail of trading. There's this group of people who achieve success without using a lot of indicators. So people do a lot of different approaches in understanding how to properly predict the market. One of them just happens to be indicators, and there is a whole list of indicators. I'm not going to talk too much about a lot of them. The ATR, for example, is the average true range. It's similar to the moving average. I've added it onto my chart, and as you can see, it tells you the range. The range now is high, and from the low, so my candle, my arrow is, yeah, from the low of this candle, the high of this candle, that's the range of the candle. Now it tells you the range of, in this case, the past 14 candles, which you get. So now the value of this range is somewhere up here as 45.86 beside the ATR. When I go on it, it changes because it's measuring everything at the moment. But if you're just going to look at where my arrow is on the main chart, you will see that it's 45.86, which is the range of each of these candles. That means each of these candles is like 45. I don't know if I'm going to call it tips, but I hope I'm making sense. Yeah, it's like I don't want to delve into it too much. Anyway, one more indicator I will touch is Bollinger Band. Bollinger Band are there's a lot to touch actually, but we won't go into them. Bollinger Bands are going to add them to my chart now, that you can see them. Any of you want me to pay money to access some of their, so I'm just going to reduce the number of indicators on my screen and then add Bollinger Bands. Bollinger Bands measure volatility. Now, they're a very interesting indicator because the way they work is one volatility of, you remember we're looking at gold. Volatility, when the volatility, we'll talk about volatility later, guys, but just get the general idea that once volatility is increasing, traders like volatility. Volatility means that you can, the distance between the high and low of candles is beginning to get like significantly large. So you can see how these candles are tiny here, and then we're not suddenly start having big highs and lows, big highs and lows, big highs, lows, highs, lows. Like that is volatility increasing. So now the way the Bollinger Band works is when the volatility is low, this band, the upper band and the lower band, start compressing. Once volatility starts increasing, the way it did here, where my arrow is, you will see that it suddenly starts expanding. Bollinger Band starts expanding. A very useful indicator if you are someone who pays attention to volatility and you want to know, okay, see how if this one just started piercing the upper band and just kept going up, showing us that, oh, volatility is increasing here. Then you see this here. This is what we call a range. We didn't talk about it today, but just for knowledge sake. And then the same thing happened here. So I think with all this, I have been able to make sense of indicators, lines, and horizontal lines, guys. Again, this is an introductory class, so we will still on the group delve properly into all these topics over time, but not at the moment anyway. So as this, if you have any questions, please feel free to ask. I'm seeing the chat has, yes. So please feel free to ask if you have any questions, guys. At this point, you can even take answers on all of them. Thanks so much, guys. Thank you, Simi. I think you can take over now. I'm going to leave my screen on in case anybody needs to ask a question relating to my screen or anything. Can I answer Gabriel's question? Simi, are you there?
Yeah, sure. I'm here. I'm here.
Can I answer Gabriel's question?
Yeah, you're free.
Gabriel says, when trading, do you adopt a strategy or multiple strategies?
It's a deep question.
There's no hard or fast rule actually, but here is what you want to think about when trading. I would like to ask and type if I can. Let me type. Yes, fantastic. I hope you can see my screen, guys. Now, when you're thinking of a strategy is a set of rules that you have come to systematically design that tell you when to enter a market, when to leave that market, and how to manage your risk while in that market. Remember how I talked about the example of 200-day moving average and price being above that, for example. Now, if I was to take that as a strategy and say, okay, the moment price closes above my 200-day moving average, I would look to start buying. And remember, above means uptrend. Remember, price closes above, I would look to start buying, that kind of thing. And then that happened. So I have gotten when to enter my market. Now, the thing is, there's different, you know how I said there's no hard and fast rule to this. The reason why I said that is because different traders adopt different modes of thinking. Some people have a couple of strategies. Some people have a basket of strategies that they employ across different things. Let's say someone trades bonds. I don't know if you guys know what bonds are. A bond is basically a debt instrument, DEBT, a debt instrument that government. I'm not going to delve into it too much, but they basically use it to borrow money from the general economy and to fund their own agenda in terms of infrastructure and all those other things, whatever projects they have, and then they pay you back with a sort of interest, which is what you guys sometimes refer to as treasury bills and bonds and all that. So that's what they are. So let's say I trade the bond market, and my own strategy for that bond market is, let's say, the 200-day moving average and that kind of thing. And then I know, okay, you know, when we are entering the market, when we leave the market, let's say when price now eventually breaks below that 200-day moving average, like it did somewhere here, yeah, I would leave that market. I would close that position. And then how do I manage my risk while in that trade? This is a strong matter altogether. Like we can't talk about this, but it is one part of trading that you cannot ignore. Now, all these are important. This is what we refer to as entry rules. Remember, I told you a strategy is a set of rules. So this is what we refer to as exit rules. And then this is what we refer to as risk management. In the absence of any of these things, you're almost certainly gambling. In the absence of any of these things, you're almost certainly gambling, right? So with that in mind, now we have established that for the bond market, I could be using the 200-day moving average strategy. We didn't talk much about we didn't talk much about how we manage our risk for that. Is the difference of the matter altogether. But let's say I'm risking 2% every time I enter that market. Every time I trade that market, I'm risking 2% of, if I have $100, I'm risking 2% of that $100, for example. We're just giving some basic examples here. Now we have all that for our bond market. Now we can say, okay, for when we want to trade the cryptocurrency market, we will be using let's say we'll be using supply and demand, something like support and resistance in some ways. So for that, we have our own entry rules for the crypto market, and then we have our exit rules for that market. That okay, remember what I drew about the horizontal lines, depicting resistance and support, and let's say when it gets to that resistance, we sell, and then things like that. Like you have that kind of thing. But to stay in one market, how did you ask that question again? Let me even make sure I'm getting it properly. So to stay in one market, yes, and adopt different strategies across different assets, it's possible. In fact, let's say whenever it's possible, yes. I don't want to talk too much about it. It's possible. But it will be difficult to monitor your entire trading progress because let's say one strategy gives tomorrow you're using strategy 2, and strategy 2 gives you lose that tomorrow. 2, okay. Unless you're using both strategies have high the things you look out for in strategies. We don't want to delve too much into it. My internet connection is stable. about that, guys? Yes, I think I should be back now. Now, the thing we look out for to answer that question as simply as possible when trading, but it's simple is trading one market is not something you unless you're very sure of what you're doing. The very sure of what you're doing, then it's not something, if it's something you're just playing around with, your results are going to look very erratic, very erratic. Right? So you want to do something that you can report on. I can say, oh, okay, this strategy is out of.
Okay, guys. So okay, I think Mamara is having some network issues.
Yes,
so, Mamara, are you back?
Yes, I am.
Okay, your network just dropped off.
Yeah.
So I think you need to reshare your screen.
Okay. Yeah. So I'll do that in a moment. So I hope I was able to answer that question, Gabriel. It's something you want to do, but it's not something you want to do unless you're totally sure of. If you're just starting out, it's best to just stick to at least one or two strategies. And then, but personally, if I'm going to talk about myself personally, I have multiple strategies, but I don't trade those strategies on the same account because I like to monitor my growth. And I like to be sure that, okay, this is what I'm fetching from. This is what kind of money I'm fetching from this strategy, and this is kind of returns I'm fetching from this strategy, and this is kind of growth I'm making from this strategy. This is kind of growth I'm making from this strategy. So that's how I work. I have like different. It's kind of like a portfolio. So I have money in this strategy and money in this strategy. Some people do it differently. So like I said, there's no hard and fast rule. People have one account, multiple strategies. That's fine, but it's not something you want to do again unless you're sure what you're doing. So any other questions, guys? I hope my session was well explained. I'm not getting any feedback. I don't know if I should be bothered. Okay, you're welcome, Gabriel.
Okay, guys. So if there's no other question, I think we would end here. Or is there any question? Let's know now before we end the call. All right. So I think.
Thank you.
Okay, so I think it seems there are no other questions. Okay, so thank you for joining us. We hope to have more of these sessions. Yeah. So thanks to everybody from the community. Yeah, so we hope you're able to learn something today. Hope we're not too boring. So, okay, see you all another time. So stay safe, everybody.
Have a good night, guys.